Hello and welcome to another episode of the Investor Financing Podcast. And please welcome Chris Roberts from Sterling Rhino Capital. And that's a question I had on the business name. I like it. I like your logo. I like everything. I started listening to a bunch of your podcasts. And right before we went live, we were just talking about, I kind of brought something up about the crazy market we're in. And you gave me some really good information and tips. Like, there's so much noise out there, and you were basically telling me about some of your wins that you didn't listen to the noise. You went with your knowledge base, and you bought some properties in the beginning of COVID, and you absolutely crushed it. So that's amazing. First off, so I think everybody's in this news and this social media environment and listening to all the world's coming to an end. And I think realistically, listen, we've been around for hundreds and hundreds and hundreds of years, the United States of America. And we're a strong country. And at the end of the day, the fundamentals are still the fundamentals. We do have rates rising, but that's a way that they want to slow it down a little bit. So there's going to be opportunities. There's opportunities today, tomorrow. And you have such an interesting background. You started as an entrepreneur and investor in 2007. And that was a time when the shit was about to hit the fan, just as you kind of got into the journey. I'm curious on, did you get in like right before the big meltdown? And then what did that look like? And then you grew, you got into the single family fix and flip business, did a lot of flipping when you were starting out. Then you started a property management company. And then you probably realized that there's a better way to grow a business by syndicating deals. And now you're doing a lot larger deals. Can you kind of walk us back? And well, first of all, welcome to the show. I'm excited to kind of dive in. I can tell you have a lot of energy, and we're going to learn a lot from you today. So thanks for joining us, and let's dive in and learn more about you.
Yeah, absolutely. Beau, thank you so much for having me on. I'm excited to share with your listeners and drop any knowledge I can possibly share. Thank you so much for the introduction. I do have kind of a dynamic background, being that I wasn't born into some sort of real estate career. I started out as an entrepreneur, had the bug very early, was on my own at a very early age, and developed a really strong work ethic. And the reason I think that's important, having a strong work ethic in general, is I believe that you can will yourself and work yourself through a lot of problems and challenges if you're willing to put in the hours, right? I think Covey stated, knowledge is power if it's applied correctly, or something to that sort. And he probably stole it from someone else. But the point is, you educate yourself and you continue putting in the work, and eventually things start to kind of work out for you. That was my story early on. When I first dove into real estate, I bought a few pieces of land around the recession timeframe, and I sold them, made a little bit of money on them, and then kind of got out of the space. It just wasn't exciting to me. There was no cash flow on land, but I did buy them at the coast, so there was a demand for land there. And I had my single family residence, and it took an epiphany from a friend who had highlighted how much money there could be made in the passive cash flow model, along with the appreciation and or equity and some depreciation or write-offs that you could see as a result of investing in it. And then I started to think more about this asset class, and I realized pretty quickly, after I started diving into reading books and just learning a little bit more about this space, because I was a stock market guy. The money I'd made as an entrepreneur, I just put in the stock market like I was kind of taught, right? I started realizing, there's a lot more effective ways to make your money work for you. And I started investigating, reading. I started building a few spreadsheets to model it, because that was before they had fancy, things you could download at a cost. I just started building these models out, and I realized, okay, well, if I take X amount of dollars, buy a foreclosed property, rent it for a certain amount, there's a nice profit there. And as long as you modeled it correctly, you could make enough cash flow to circumvent any potential issues, vacancies, maintenance, things of that sort as well. And we did that. And then every 6 months we did it again and again and again. To step back a little bit, I wasn't an extremely wealthy guy, even though I had built a sales career fairly early and had some money coming in. I lived kind of up to my means, I guess, if you will. And I invested a little bit, paid myself first, invested a little bit in the stock market, but didn't have a ton of money left. So I realized, in order to get myself into a cash position where I had some money to do something else with, I had to start saving. And the only way to do that was to literally drive the same car for 12 years and save those car payments. So that's where I got that little safety net, if you will, but for me to jump into my first investment property. And then I used that money as a barometer to drive me to buy the kind of property I could actually afford, which actually took me outside my comfort zone, because instead of buying right next door, I couldn't afford that. I had to look as far out as possible until I found a market that would work within the money I had. Then I just kept buying there, and it worked out really well. Ironically, it was in the same market that Brandon Turner from Bigger Pockets was buying in. And I learned a lot about his modeling, and then also actually shared the same electrician as him, which was kind of funny. Later on, I found out and found, wow, he was here far before I was, but obviously there was something in that market that he saw early on as well. Right. And then that led me into traveling down the journey of single family, which led me to wanting to scale and help others. And we got into the multifamily space, and it was a rocket ship from there. So that's a little bit kind of fast, long story short.
Well, that's a great story. And yeah, I know Brandon. He's a nice, totally nice guy. And it's sad to see him leave Bigger Pockets, but I know he's on to some amazing things. It's been amazing to watch him once he started to syndicate deals and start his open door capital or whatever. Right. And
yeah,
so
he's doing great. He's doing great.
Yeah. He's just he's a natural podcaster, but that's what I miss about listening to his show. But good for him. And you have an amazing story. So that's awesome. So your last deal that you just sold, you had like a huge return for your investors, right? So I guess how do you let the investors know, listen, this is like a grand slam. We shouldn't expect to get returns like this. It's not normal. It was great find, great deal. And COVID kind of 10x 3x the results a little bit, or whatever you want to say. Because that's like one of the big things, is that if you kind of spoil the investors. When I was doing a lot of flips, I like paid my investors too much in the beginning. And then it was like, well, why am I paying this much? I'm really doing all the work. And it's kind of maybe the same model with like multifamily syndication, that, if the syndicator or the operator does a really good job, or like the market just has a great boom and you deliver. Now, how do you set the expectations? Like, listen, this is like a really, really good deal, and we shouldn't expect to see this again. Or, this is just like, how do you kind of set the tone that, like, to let people know that this is where we're expecting to be, but this was a home run deal, and listen, the next deals should be more in line with our projections, but sometimes there's anomalies and different things. I mean, just coming off such a success, I guess, how do you keep the investors engaged, saying, hey, listen, we're going to do well going forward, but this was a home run, and just set the expectations for them?
Yeah, Beau, that's a very good question. Thank you for asking. And it's a dynamic one, because you cannot change the behavioral traits of an individual, right? So like, you have a certain way of seeing things through the reflection of the way you live your paradigm, right? I could tell you all I want, the circumstances, the situation, the whatever, but you're still going to have those inherent traits that are human. We want what we want. We get excited. We get let down. We're emotional creatures, and so on and so forth. But I believe transparency is the key, and constant communication. I mean, whether it's bad news or good news, or high returns or low returns, I just want to be told the straight story, right? So like for our investors, for example, we said to them, hey, we're going to buy during these challenging times, right? And people stepped up and they invested with us in multiple deals. We bought 8 deals during COVID, right? It was crazy. And a lot of people believed in us because of our passion, our enthusiasm, our modeling. They trusted us, right? And some deals we blew up. That's not always going to be the case. But we had basic conservative underwriting. Let's just say you underwrite to your norms, which are like the 15 to 20% annuals, IRRs 14, 15 or so, maybe a little less, and then an equity multiple of 1.8 to 2.0 or whatever it may be, right? Because that's your modeling. Now, who would have guessed that rents would have escalated as much as they did with inflation and so on? But you also have variables where you execute your plan a lot quicker. You have supply and demand issues that push the value up quicker than you think, right? Because the value of a property is somewhat weighted on the amount of income it makes, but also weighted on the ability for someone to pay whatever they're willing to pay for it, right? So, I mean, if someone comes in on a single family and they're willing to pay 50 grand over what it's worth, well, then that's what you're going to get, right? So we tell the investors everything along the way. We set the expectations when we announce, because we're about to close this deal. It's like in a week. But we have announced to some people about what we think they're going to get. People got emotional. Literally, the returns are so high, they got emotional on this deal, right? And we were like, listen, this was a total one-off. We all got lucky in some cases. Yes, we executed early. We got out early. It was a hot market or whatever. But understand that the next deal you see is probably going to be more in line with where we're at. And here's why. And we explain why. We're going into a potential recessionary period. Cap rates are compressed like crazy. The asking prices are astronomical, even over the last 6 months. I mean, they've just skyrocketed, right? And so our numbers could actually come in a little lower than we project. Obviously, we try to be conservative, but it's really hard to go out to the investor base and say, we're going to promise you, because we're always promising, right? Our projections, we're going to promise you a 10 to 15% annual when they're used to seeing a 15 to 20, right? So you want to still kind of stick to your modeling, but explain there are a lot of variables that can affect that, and just be transparent about it. I mean, you're never going to stop some people going out and searching for an 8 pref, a 10 pref, a 3 times equity multiple or whatever. But if they have any common sense and you're good at articulating and explaining these things, they're going to understand. And if you did your job and you returned way above what you promised, it's very likely they're going to stick with you, regardless of if you get them those returns or not, because you delivered on your promise and you were transparent the whole time. I mean, you know, we also communicate if there's a shooting or if there's a fire or if there's someone stealing as a manager. I mean, things happen, right? These are properties that have a lot of dynamics involved and a lot of people, and humans make mistakes, right? And I think it's really important to explain all that stuff to people. I mean, yeah, that's my answer.
So you still own a portfolio of single family homes in the Washington area, but your focus for multifamily is in like Georgia. What states do you like going forward here?
Yeah, we have several properties in Northwest Texas. We have properties in Georgia, several there. We have our fund has some properties in South Texas and in Florida. We just sold in Virginia. We like the Southeast. That's mostly because it's landlord friendly. There's opportunities. We have very good broker relationships and we have good deal flow. But that's not to say we might not dive out a little, especially as this market changes and the dynamics change with deal flow and whatnot, right?
Are you sticking with all your holdings really, besides the personal holdings you have, are mostly multifamily? You don't own self-storage or any other asset classes at this time?
No, 100 unit plus value add play BC type properties. We like larger CapEx projects. I mean, we have a $2.5 million CapEx budget on one project. We have 1.5 on another, 800,000 on another. I mean, we like that stuff because that's where we find there's tremendous meat on the bone and lots of opportunity for the investors to have nice returns. But not to say that storage and mobile home and car washes and everything else aren't good. It's good to diversify. I think any investor should look at that. We just found that we're very good at what we do, and we don't want to dive outside that model because to do so, we'd have to bring in other partners that were experts in that field. And we find that this is working for us for now.
So what does your team look like? I mean, it probably took you a while to build your team where you are right now. Do you do the underwriting, or what? How do you delegate officially? Delegate efficiently, because what I'm looking at, because I haven't done any syndications, is I'm in the lending business, so I see a lot of everybody's moving parts. But I'm just curious on how to effectively, if somebody's listening, okay, there's probably 2 types of people. There's people that want to invest as a limited partner and learn the business that way. And then there's people that want to be operators. How did you build your team, and what is the responsibility? It seems like it's a team sport versus like the single family flipping business is more of an individual sport. So how did you build your business?
Yeah, this is a very good question. And thank you for asking, because there's not a lot of talk about team. And I think it's really important to highlight it because everyone gets to syndication or sponsorship in different ways. There are folks who go out and start and they think, I'm going to hire a mentor and I'm just going to go build a syndication business. And they're very linear in their way of thinking, right? They're not abstract. They're not kind of thinking all over. I'm an abstract thinker. I think all over the place. Like I'm always trying to think of maybe what I'm not thinking of. Like maybe this guy's doing something different. Maybe this guy's doing something better. Or maybe this person can add value to me or build upon my weaknesses. And that's how I found my partner. Is he's an analytical guy, infrastructure guy, back-end, systems, processes, doesn't want to be on camera. I'm the exact opposite. I can do all that. And I've done that. I did it with single family, not a problem, but not a space I want to live in. So I immediately resonated with him. And we both decided to go about this journey together. Now, I had already started, but I just basically said, let me bring you in. We'll partner up. You be CEO, or you be COO, I'll be CEO, and we'll build out from there. And that worked extremely well for us. We trust each other. We got each other's back, and we both execute efficiently our roles and goals. From there, we hire investor relations director, right? An underwriter. We have a fund manager that's on our team. We have social media and so on and so forth. And we're continuing to build out. Now, the question is, what comes first, like the chicken or the egg, right? I think you need one person on your team. If you have the wherewithal, at least one person who has strengths that you don't have, and you can build out from there, right? And then obviously you want to start building out your thought leadership and so on. Everyone looks at it differently. For me, it was, I immediately recognized, in order for me to scale and grow, I need key people on my team that I will treat as equals. That doesn't mean that everyone has equal ownership necessarily, but that means I will treat them all as equals. So for example, we partnered with another person that was in one of our groups and had him start underwriting. He was very busy. He was full-time, but he said, you know what? I just want to be an underwriter, but I'd love to be on your team. Perfect. Right? He didn't want any other responsibilities. He just wanted to underwrite. He's a market expert in our market. So we brought him on board as a general partner. And now he underwrites deals constantly for us, right? And then we have other folks, like I said, our fund manager, who, again, she pretty much just wants to deal with our fund. She wants to help with debt and deal with the insurance. So we have her do that. She does a little bit of asset management, right? We now have an investor relations director who's going to help with some of the investor relations infrastructure and actually manage that process, even though I actually, even as CEO, still take most of the investor calls because I really enjoy it, right? That's my sandbox. I actually love those conversations. So I think you just have to identify what roles and goals you need to fill and make sure that everybody has the same sort of vision and purpose. That way you guys are going the same direction. Otherwise, it's not going to be a good fit, and you're going to have a revolving door and an awful lot of frustration. And the last thing I would tell you, Beau, on this is be careful with general partnering with a bunch of random people. Yes, that is a great way to get into the business. And I encourage people starting out to maybe jump on someone's deal, raise some money, take on some responsibility, earn your way in so you can ride the coattails of an expert and maybe learn, could even be a mentor of yours or something. But be careful, because remember, if you don't have control of that deal, right? You're at the mercy of whatever it is that they do, including bad boy clauses and all the other stuff that could come up as an issue, right? So I think it's really important, even with these people you co-GP with, let's say, that you either do background checks or thorough interviews, or just have good, honest, straight up conversations about where your value and vision is and how your communication is going to be with investors. That way you don't get each other in trouble or get a bad blood created out there and, like, you know, all kinds of talk that goes on. You don't want that, man. This is actually a fun, exciting business. But if you don't do your work ahead, you can get yourself into a lot of trouble.
That's really good advice, because I see so many people and people I'm interviewing, that's like they're doing this whole co-GP thing, and I get it. It's a quick way to accelerate your, hey, I've got the experience. I'm a GP on this many units, which supercharges it, right? It allows them to maybe get agency loans and things like that. But yeah, I think that people have to be careful too, because if you're not the one calling the shots and something goes wrong, and because at the end of the day, the number one thing to do when you're raising money is protect the investor's capital. And if you don't have control, I would feel pretty awful like being in that position. So that was a very valuable point, and I hadn't really thought about it, but like, because I always looked at myself like, what roles would I be good at? And definitely not underwriting deals. It'd be more of the public figure, raising capital. But who am I going to align with that I feel comfortable with, that I trust? It's a trust thing. And I like the idea of doing background checks, because you never know. People will tell you anything, and we know that. So really really good advice. Prior to the real estate world, what were you doing though? Like did you have your own business, or what was that, or your corporate world?
Yeah, sales and marketing career, building out, being factory rep for companies and selling products and services and goods. And I branched out and started, sort of diversifying into other lines, and was extremely successful in that space. Very fortunate. Most of it was just developing sort of, the conversational piece and getting to know people and having fun in the business. That was sort of my sandbox, was just being out there like an extrovert, right? And that worked well for me in the sales business because I could talk to anybody. I had no fear, and I did really well in that space. We had that territory up to about $30 million or so, $30 million or somewhere in there. And I used a lot of that money that I was making to invest in stocks and then eventually a lot of real estate, right? And I had other businesses, like I'm a partner in a software company. I'm a passive now. I was originally an active, and I've done other things. I've helped other people open businesses and whatnot. But real estate is the space I love being in. It's the most fun for me. It's the most challenging and definitely most rewarding for sure.
So you're a very high energy guy, and we just met recently. And so I'm curious on like your daily regimen, your personal development. I have a feeling you do a lot. You're very into personal development. I see a lot of books behind you. What are your favorite books? What are you doing to like keep yourself high level? Where did you get your concepts for building out the company the way you're doing it? Are there particular books you like Traction or any of those type of books? It seems like you're very forward thinking. So I'm curious on that.
Yeah, Beau, the best way I can describe it is, and this comes from my early upbringing of having challenges growing up as a young person, being on my own at a very young age. There was this sort of, I guess, fire, passion, enthusiasm developed in me naturally. It wasn't given to me. I don't know where it came from, but there was this sort of, this fire to go out and succeed, to sort of just build something, to be worthy. That's the best way I can explain it. Is I was always fighting to be worthy, to earn the respect of people. Why? I have no idea, because you're living in your own bubble when you're growing up. Like, you don't really know what people think about you. You assume things, right? Everyone feels like they're being judged, and we're insecure. And in general, unless you're part of the football team or whatever it may be. And I think that fire in me started out at a very young age. And as I began building upon that, I realized, look at these people around me that are successful. Why can't I be successful too? And what do I have to do? So I started watching these successful people around me. And it could have been selling furniture in a furniture store. It could have been in the software business. Any of the stuff I did, I gravitated towards the people that were winning, the people that were succeeding, the people that a lot of people were naysaying. A lot of people were judging. A lot of people were saying, oh, that person has this leg up, or I thought, no, there's got to be more to it. And I started learning from those people, and I would extrapolate the things they did that I knew I could do, but maybe do a little better. And then I looked at some of the stuff they were doing and thought, that's just too much work. There's probably a better way, or I don't want to do that. And I did that at a very young age, all the way through my career. And then I would read books. If I wanted to learn about real estate, I'd read 5 or 10 books. I would listen to all the podcasts. I would fill all my free time learning about that craft that I wanted to execute, all my free time. I'm talking at the gym, in the car, in the bathroom, you name it. Every minute was absorbing that content. And then I would go put it into action. I don't just go to events all the time to network with people, because networking only gets you so far. You have to actually apply that knowledge and take action, right? You have to do stuff. You have to buy properties. You have to get on teams, whatever it takes. And I did that. So yes, I've read tons and tons of books. I love audiobooks. I love podcasts. I also learn by interviewing people myself and asking a lot of questions and genuinely caring about what people say. Because even if they're not talking about real estate specifically, there's a lot of lessons to be learned by hearing other people's stories, especially of overcoming adversity and strife. You can learn a lot. And that's how you can stay inspired. I get asked that a lot. How are you so fired up all the time? I'm fired up because of my own life experiences, and I never want to be in the struggle again, right? And then I'm also fired up by other people's successes. I look at them and I go, man, good for you. You made another million. You bought another property. You donated $1 million to charity. I love that. And that fires me up, and I want to be there. It doesn't even have anything to do with money. I want to win too. Right? I want to succeed, and I want to help others succeed. And that's where the fire comes from, and how I stay fired up all the time.
I love it. I love it.
You're listening to the Investor Financing Podcast. We'll be right back after this break. Are Are you looking for funding? Are you getting frustrated trying to find a lender? Visit investorfinancingpodcast.com and click the Get Funding button. Complete the simple form and schedule a free phone consultation with one of our placement specialists. We have a proprietary directory of funding partners that can help you get the funding you need. It's fast and easy to explore the options available for your specific needs. Don't wait. Visit investorfinancingpodcast.com and get connected.
Now tell me about how you came up with your company name. I'm curious on Sterling Rhino Capital, right?
I get asked that a lot. Yeah. So I had the LLC from a previous business that I ended up not using the LLC for. And I love rhinos. They're an endangered species and it draws attention to the rhino, which is kind of cool. I like the logo. It was like strength and conserving an endangered species and just the whole thing, right? It made sense. Sterling was really just a sort of fancy name I threw in front of Rhino because it was like Rhino Capital. I don't know. I didn't feel it. So I thought, well, Sterling Rhino kind of rolls off the tongue, and then capital versus investments. Our corporate LLC is actually Sterling Rhino Investments, and then the brand is Sterling Rhino Capital, which is trademarked. But that's where it came from. And I actually buy cocoa that supports endangered rhinos. And so the chocolate I eat actually supports endangered rhinos. So thank you for asking. It also draws a lot of conversation, right? And highlights the endangered rhinos, which is pretty cool. So,
Yeah, that's cool. And I do like the logo too in the back on your wall.
Thanks,
there.
Man.
That's pretty sharp. So what are we're already a quarter of the way in 2022. What kind of planning and what's your kind of, do you do quarterly, goal setting for like, hey, this is what we want to do? Because you need to look at a certain amount of deals every week, every day. You got to be, that's really the acquisition part right now is probably the toughest part. I mean, I think now with your track record, raising capital has become easier for you to a certain degree, probably. I'm just assuming because it seems that once you have a track record and you're winning and your limited partners are winning, they're happy and they probably want to stay with you because you've been transparent. You've done better than what you've projected for them, so they're happy. So now it's really acquisition side is the challenge. Where's the bottleneck right now for you? Would you say, or are you guys not bottlenecked right now?
Yeah, you asked a few things there, I think, and I'd like to break them down. So one was goals. You referred to goals. I was always a goal guy in corporate America. Goals. And we achieved a lot. It was great. We're not big goal guys in our company as a team and gals. We have men and women in our team. We're more about our brand, our vision, our purpose, and working every day to be better at that and get the word out about that. Now, what I mean by that is we don't set goals as in we need to attack 500 more doors this year, 2,000 more doors this year. We need a deal right now, blah, 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 right? We're more about how do we build our brand more? What is our revenue goal, regardless of doors? Do we need to do 50 million, 30 million, 100 million to actually pay the bills, right? And then put money in our pockets and so on and so forth. So we kind of work that way. We work more on our brand, our vision, our purpose, and then the deals just come. We had plans of doing a few deals when we first started. We ended up doing like 6 and 7 months, right? It was nuts all of a sudden out of nowhere. Then we were selling 2 properties on top of that. We never imagined those numbers, right? But it was also chaotic. I mean, that's pretty crazy to be doing all those transactions. So now we look at it and say, well, you know what? If we do a few deals a year, that's perfectly fine. We'll hit our modeling. If we do 6 deals a year, we can. But again, it's more about our vision and purpose. And as far as what's coming in second quarter and third quarter, we look at what's going on in the interest rate worlds and in the economy and, with our deal flow, and we test our investor base. Hey, we survey them, what's going on? What are you feeling these days? Are you thinking you might want to jump into another deal, this, that, and the other? And that gives us a good feel, the barometer. You can also measure things by how many new investors are coming in. Things start to slow when chaos breaks out in the world a little bit because everyone just gets a little more cautious. But we're not fearful. We think the economy is going to shift and shuffle. I personally believe the interest rates are going to go up for a little bit, and then I think they're going to come back down and stabilize. I don't know that they're going to go to the 1980s, 17, 18% interest rates again, right? The main reason for that is that the only way for us to get out of this debt situation, 30 trillion or whatever, is for us to raise the economy, right? Raise the GDP. And you can't do that when you have astronomical interest rates. Yes, you need those to slow down the economy a bit, but then it has to ease up a little in order to stimulate the economy growth again. So we'll see what happens, but we don't freak out about stuff like that. I think we have a vision for where we need to go for the year. We're looking at everything that's going on, and mostly we're just trying to build out our investor base and make sure we take care of the ones that we have. And it seems to be working out well.
That's awesome. Well, Chris, this has been an amazing interview. I could talk to you for hours, but I know it's Friday and we got things to do. I got prime rib to eat for dinner. But where can people follow you? And also the name of your podcast, because I'm sure it's a wonderful podcast with the amount of energy you have and experience. So where would you recommend people follow you?
Yeah, I recommend, if you want to learn anything about us, we have a great YouTube channel, but I would go to the website and start there, sterlingrhinocapital.com. You can get everything you need there. You can join the club, or you can join the podcast, or any of that stuff. Check social media. You can get everything on the website. And then the podcast is the Charging Forward podcast. So chargingforwardpodcast.com, you can find us. And we interview entrepreneurs, not just real estate people. So if there's anybody out there that's an entrepreneur or has overcome some adversity and challenge in their lives, check us out. We'd love to hear your story. That's really what that podcast is about.
Awesome. I love it. Everybody, I hope you enjoyed another great episode. I'm scouring all over, finding the best people to bring on the show to motivate you and motivate me. And just like we were talking about earlier, this is really motivating. And now I'm all motivated, like, okay, right. So that's why I love doing this show, is because I get to interview people and get motivated all the time, like as much as possible. So thank you for taking the time to meet with us, and we'll follow you and continued success. And thanks for all the tips you gave us today. And everybody watching, please like and subscribe, and we'll see you on the next episode.
Thanks, Beau. Have a great day.
All right.